Today, boon times maybe, but we'll feel the squeeze. Market update for the 6th of November 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we review the week's action on the markets as stocks reach new highs in the light of dovish comments from several central banks, which took some of the tops off bonds and cast inflation fears in a fresh light, despite the fact that the costs of many things are rising due to the supply chain issues. The major US indices ended the week at record highs on Friday, as a better-than-expected monthly jobs report and positive COVID-19 treatment news triggered a sea of green across Wall Street. A rally in companies that stand to benefit the most from an economic rebound drove stocks higher after solid jobs data. Airlines, cruise operators, hotels and small caps all jumped, but in contrast, Treasury 10-year yields sank below 1.5%. The narrative around wage growth and very strong job creation suggests to me we are nowhere out of the woods in seeing higher bond yields going into 2022, Jefferies chief global equity strategist Sean Darby said. In a tweet, Mohammed El Arin said, overall, this report is much more consistent than the prior one, with what else is going on in an economy that remains vibrant and growing nicely. It also points to what has become the key issue in the US and elsewhere, that is, the continuing malfunctioning of the supply side. All major equity benchmarks climbed to records, with the S&P 500 posting its fifth consecutive weekly rally, the longest since August 2020. Industrial and commodity shares outpaced technology firms, although the Nasdaq 100 still rose for a 10th straight day. The US labour market got back on track in October with a larger than forecast and broad-based payroll gain, indicating greater progress filling millions of vacancies as the effects of the Delta variant faded. Factory employment jumped by 60,000 in October, the most since June of last year, and largely reflected a surge in automakers' payrolls. Non-farm payrolls increased 531,000 above forecasts for a gain of 450,000 after large upward revisions to the prior 2 months. The unemployment rate fell to 4.6%, while the labour force participation rate was unchanged. Hourly earnings came in line with estimates, rising the most since February. Average hourly earnings rose 4.9% in October from last year and 0.4% from September as firms continue to hike wages and competition for employees, particularly in the leisure and hospitality sectors. Hourly wage growth did slow, though, from 0.6% monthly gain in September. The ongoing rise in wages, however, leaves the Fed Reserve vulnerable to falling behind the curve on inflation, potentially raising the risk the central bank may be forced to hike rates sooner. People will feel that squeeze from rising prices, and that will then translate into more pressure on the organisations to raise wages, and now that's coming through in the numbers, Joanne Gran, head of ETF strategy at Allianz, said. That's where I see a risk of the Fed perhaps underestimating the impact rising wages might have on inflation. The strong jobs report is a welcome sign that the Delta wave-driven slowdown was indeed transitory. This bodes well for the expansion, which is set to continue in the coming months, driving earnings and economically sensitive stocks higher, said Matt Perron, Director of Research at Janus Henderson Investors. Investors are looking for a modestly growing economy as the Fed starts pulling back the reins, and the October jobs report seems to fit that bill, said Lindsay Bell, Ally Invest's Chief Markets and Money Strategist. This is a strong progress from the job market that we wanted to see. Some of the pandemic-driven headwinds preventing people from taking open jobs have started to abate, and given strong demand, we expect to see even better numbers in the months ahead, said Jeff Bulbinder, equity strategist at LPL Financial. But President Joe Biden said on Friday that the US economy is recovering from the pandemic faster and stronger than expected, but then the House is expected to delay a vote on President Joe Biden's $1.75 trillion economic plan amid questions over its costs. Meantime, Federal Reserve Bank of Kansas City President Esther George noted that bottlenecks contributing to high inflation will persist well into 2022 amid broadening price pressures, suggesting officials should not wait too long to respond. The S&P 500 rose 0.47%, closing at a record of 4,697. The Dow Jones Industrial Average was up 0.57% and hit an intraday record of 36,328. And the Nasdaq added 0.2% to end at a record of 15,971. And in small caps, the Russell 2000 futures also clinched a record close. Actually, among the indices that made record highs this week, the Russell 2000 record high was perhaps the most notable, reflecting bullish investor sentiment on the risk assets. In the last 6 months, you've seen the market rising, but with small caps and mid caps largely not really participating, Chief Market Strategist David Keller at Stock Charts told Investing. But there has been a change in the last couple of weeks where small caps are actually emerging, and the Russell 2000 is breaking out of a 6-month base, showing that investors are optimistic and putting risk back on, Keller added. That tends to lead to higher prices. The volatility index was up 6.74% to 1648. Gold futures for December delivery was up 1.4% to 1,818, and crude oil for delivery in December rose 3.24% to 81.36. The euro-US dollar was up 0.13% to 1.1567, and the US dollar future index was down 0.14% to 94.207. Energy stocks rebounded from weakness a day earlier as oil prices resumed their climb higher following OPEC and its allied producers' decision to keep production steady despite US calls to ramp up output. They did confirm a monthly increase of 400,000 barrels a day at a meeting on Thursday, rebuffing calls from the likes of US President Joe Biden for a more substantial increase in output. Over in Europe, European equities wrapped up another week of gains on Friday, led by advances in travel stocks after the positive update from US drug maker Pfizer on its pill for COVID-19 and amid persistent optimism about the earnings season. The pan-European Stoxx 600 ended flat, but clocked 1.7% in weekly gains, its 5th consecutive week in the green. European travel stocks jumped 1.4% as investors across the globe cheered Pfizer's trial of an experimental antiviral pill for COVID-19, which was shown to cut risks of developing severe disease by 89%. The news lifted shares of Swiss duty-free retailer Ruffray by 10.1% to its best day since November the 9th, 2020, while also pushing down shares of AstraZeneca. Today's news out of the US that Pfizer has developed a COVID-19 pill, which is 89% effective in preventing hospitalization, may well be weighing on the AZ share price a touch, but it has pretty much turbocharged the airlines and hospitality sector, said Michael Hewson, Chief Market Analyst at CMC Markets. Dovish moves by the US Federal Reserve and the Bank of England and similar comments from the European Central Bank have helped sentiment this week. Germany's DAX reversed earlier declines to scale fresh peaks as investors shrugged off disappointing industrial output data in Europe's biggest economy. A rebound in London-listed banks, which dropped after the Bank of England's move on Thursday to hold rates, saw London's FTSE gain 0.33% to 7,303. The Bank of England surprised investors on Thursday by keeping its interest rate steady the day after the US Federal Reserve indicated that it would be patient on interest rate hikes while beginning asset tapering. Later in the week, European Central Bank President Christine Lagarde pushed back against market bets for a rate hike, stating it was very unlikely such a move would occur in 2022. Central banks are proceeding cautiously with the normalization of monetary policy, allowing their economies as much time as possible to recover from the ravages of the pandemic and risking inflation, of course. Weighing on the German stock market was a surprise drop in the country's industrial production of 1.1% in September as supply bottlenecks for raw and preliminary materials continue to take a toll on output in Europe's biggest economy. French production also fell the most since February, and Spanish output growth fell to its lowest in the same time frame. And in corporate news, IAG stocks fell 3.4% after the parent company of British Airways said it was heading for a €3 billion or $3.5 billion loss for 2021, illustrating the impact of the pandemic on international travel. Its prediction of a recovery next year actually didn't help noticeably. Asia-Pacific stocks were mostly down on Friday morning, hitting pause on a recent rally. Investors are digesting recent central bank policy decisions and are containing expectations about the likely pace of monetary policy tightening to curb inflation. Japan's Nikkei 225 fell 0.61% to 29,661, and China's Shanghai Composite was down 1% to 3,491, with authorities urging China Evergrande Group founder Hugh Kaiyan to use his own money to alleviate the firm's debt woes. Evergrande closed at 230. Elsewhere in the troubled property sector, investors are also keeping an eye on Kaiser Group holdings. Now in Australia, the Australian share market climbed for a third consecutive session on Friday, capping off a strong week for local and global equities, which rallied through a busy period of central bank announcements. The ASX 200 rose 0.4% to 7,456 on Friday and ended the week 1.8% higher. Friday's advance was led by Link Group, which received a $5.38 per share takeover bid from US private equity giant Carlyle. The offer, which values Link at about $2.8 billion, is being considered by the company's board. The stock surged 8.6% to $4.70. News Corp leapt 6.9% to $33.90 after reporting a net profit of $269 million in the first quarter of the financial year 2022. REA Group, which is majority owned by News Corp, delivered a revenue growth of 22% in July to September, despite lockdowns in Melbourne and Sydney. REA shares jumped 5.6% to 176.81. Westpac became the first major bank to increase home loan rates following the RBA's decision to abandon its yield curve target. The stock tumbled 2.8% to $22.55. CBA followed suit, but its share price rose 1.1% to $109.71. ANZ added 0.3% to 28.80 and NAB advanced 0.8% to 28.93. The Reserve Bank upgraded its economic growth forecast and said its central scenario is for a first cash rate increase in 2024 in the central bank's latest statement on monetary policy. A large earnings miss by US payments giant Square weighed on Afterpay shares, which declined 5.5% to 117.50. And Virgin Money UK dived 11.3% to 315 after its trading update fell short of expectations, while Clinuvel Pharmaceuticals plunged 12.5% to 35.50 following a broker downgrade. Woodside Petroleum dropped 1.8% to 22.58 after cutting its gas reserve forecasts. Rising prices across the economy, from labour and transport to food and insurance, have pressurised blue chips to shoulder higher costs, isolating companies with weak pricing power and spooking investors who are beginning to worry about the impact on profits. Fast food outlets, chicken farmers, insurers and building materials companies are among the businesses to warn of rising prices in September quarter updates over the past fortnight, underscoring one of the biggest challenges facing corporate Australia as the economy rebounds. On Wednesday, Domino's Pizza said it faced raising food prices, sending its shares to the worst day in 4 years in the following session, while Ingham's, the poultry group, said rising feed and transport costs meant the company may have to increase the price of chicken nuggets and schnitzel. And last week, Nick Hawkins, chief executive of general insurer IAG, described inflationary pressures on claims costs as a headwind to margins. Peter Wilson, chief executive of Reece, which produces plumbing fixtures, warned inflation across most commodities, compounding risks from labour shortages, rising inflation, supply challenges, and lack of availability to skilled labour in comments to shareholders. Taken together, these snapshots reveal the powerful inflationary tide that has begun to push companies to increase prices in a move that threatens to crush profit margins and expose the laggards that are unable to pass on cost to consumers. There is definitely worry, particularly on the wage side, to the extent it means it is harder to attract and retain staff, said Katie Hudson, head of Australian equities research at Yarra Capital Management. There's a risk we've passed peak margins with these cost pressures coming through, she said. The growth threat of higher prices comes as inflation data around the world points to lasting impacts from the pandemic shock, pushing central banks led by the US Federal Reserve to begin scaling back monetary support. Though on Tuesday, the RBA formally dropped its yield curve control policy and considered rates could rise as soon as 2023. The threat of persistent inflation has refocused fund managers on identifying companies with adequate pricing power. That is the key question, said Ms. Hudson. Commodity companies or industrials who operate in competitive markets will struggle to pass that cost inflation through. Ingham's this week revealed its own hesitancy in rising prices, reflecting weak pricing power in a market at the mercy of dominant buyers like the supermarket chains. We know that with supermarkets, it's hard for smaller companies to push through price increases, said John Lockton, head of Australian equities for Brokers Wilson. That is definitely the case with Ingham's. ANZ Bank is the latest major institution to have altered its RBA cash rate guidance. Economists accelerated RBA rate timings on inflation fears. Inflation has a mixed impact on the share market. Overall, it indicates economic growth, which is good for share prices and supports sectors such as financials as interest rates rise. However, sectors such as tech and healthcare can suffer as inflation weakens the present value of future profits. Even fund managers that remain sceptical about the lasting impact of inflation today are tweaking portfolios in case it persists. I'm on the fence, said Steve Johnson, Chief Investment Officer at Forager Funds, who has nonetheless hedged his portfolio against lasting inflation. We are buying some insurance in the form of commodity stocks and being careful about exposure to long-duration tech, he said, referring to companies valued on profits paid far into the future. Tech is also an area of growing concern at Yarra Capital Management because of a tight market for talent that's compounded the headwind to valuations already caused by inflation, said Ms. Hudson. It's evident right across the sector. Every tech company we're speaking to at the moment is talking about double-digit wage inflation and a challenge to recruit staff, she said. Building materials companies are another potential sector that could also show stress, according to Simon Conn, a portfolio manager at Investors Mutual. As borrowing costs begin to increase, consumers will scale back what they are willing to pay for renovations and new properties, he said. It's going at such a rapid rate and it's hitting different companies at different times depending on their supply chains, Mr. Conn said. The way to position portfolios is to hold companies that have strong market positions and have the ability to move prices. The Reserve Bank of Australia is forecasting the economy to contract 2.5% in the September quarter, but it's upgraded its outlook for growth in 2022, tipping a strong rebound out of the COVID-19 crisis. The central bank revised up its central case inflation forecast following a stronger than expected result in the 3 months to September 30, though its outlook for wages growth remains subdued. The damage to the labour market from prolonged lockdowns in Sydney, Melbourne and Canberra is already reversing, and the jobless rate is expected to fall to 4% by the end of 2023. With the economy now opening up, the solid momentum evident before the Delta outbreak is expected to resume, the RBA said in its quarterly statement on monetary policy. Booming house prices have boosted household wealth to record levels, which was further bolstered by almost $200 billion in additional savings being stashed away during the pandemic. How much consumption responds to higher household wealth is a key uncertainty in the outlook, the RBA said, adding a strong best-case scenario could support stronger economic and employment outcomes. A stronger pickup in household consumption and business investment supports faster growth in employment. The resulting decline in the unemployment rate to around 3.25% induces a strong recovery in wages growth and inflation over the next couple of years, with inflation rising to be above 3% by the end of 2023. Tapper Strickland, head of economics and markets for NAB, said the best-case scenario was consistent with rate hikes from early 2023, when many economists were tipping. That could support a hawkish interpretation of the post-board message that a hike in 2023 was plausible, Mr. Strickland said. But while Governor Phil Lowe this week said there were labour market hotspots across the country experiencing wages pressures, the statement noted a fast recovery in labour supply would act as an offset. That will expand further as the borders reopen, the statement said. Given the spare capacity and the inertia in the wages setting process, wages growth is expected to increase only gradually. And the RBA said it would not hike rates until wages improved. The bank's central case scenario is for wages growth to pick up above 2% by the year's end and to reach around 3% by the end of 2023. And Dr. Lowe said that wages growth north of 3% is likely to be necessary for inflation to remain sustainably within the bank's 2 to 3% target band. At 2.1%, core inflation was within the RBA's target band for the first time in 6 years in the September quarter figures out last week, but with 2/3 of the increase attributed to petrol prices and home building costs, the RBA is more subdued than financial markets and economists with its inflation outlook. It is tipping underlying inflation at 2.25% by the end of next year and 2.5% by the end of 2023. 2023. Now, a week after ASIC gave crypto asset-linked exchange-traded funds the go-ahead, the BetaShares Crypto Investors, CRYP, ETF, has smashed trading records. CRYP debuted on the Australian Stock Exchange at around 10:30 a.m. at a price of $11.23. Within the first 15 minutes on the market, the ETF experienced a surge in demand from investors. Trading volumes in that initial period was estimated to be at around $8 million, which puts it on par with the record-setting first-day trading volume of Hyperion's Global Growth Companies Fund. However, that figure quickly tripled. Trading volume for the CRYP ETF was estimated to have reached around $28 million by 1 p.m. While the Crypt ETF does not include any crypto holdings of itself, it provides Australian investors with exposure to a number of global companies involved in the cryptocurrency space. The list includes Coinbase, Riot, MicroStrategy, and Silvergate. Ahead of the launch of the Crypt ETF, BetaShares CEO Alex Vaneco said that he expected significant demand for the fund to come from experienced and first-time crypto investors. He said that the crypto economy was highly dynamic and growing rapidly, but that the Crypt ETF would seek to take advantage of the disruption through a pick-and-shovel approach to the sector. Crypt will be an innovative way for investors to get exposure to the crypto sector in a familiar, liquid and cost-effective ETF structure, he said. The successful launch of the Crypt ETF comes a week after ASIC issued new guidelines for crypto asset-linked securities in Australia. These requirements include a commitment to compensate investors for losses incurred by poor custodianship practices and formal disclosures regarding the specific technological, financial and environmental risks involved within crypto assets. Crypto assets have unique characteristics and risks that must be considered by product issuers and market operators in meeting their existing regulatory obligations, ASIC Commissioner Kathy Armour said. Now, over in New York, Eric Adams, the new mayor of the city of New York, has once again publicly shown support for Bitcoin. The mayor has long been in support of the cryptocurrency, saying he wanted to make New York the Bitcoin capital of the country. His most recent show of support has only reiterated the mayor's plan for the city. Mayor Adams responded to a tweet from Francis Suarez, the mayor of Miami, famous for making the city a crypto hub. Apparently, New York is in a race to make the city the cryptocurrency center for innovation over the city of Miami. Investors and entrepreneur Anthony Popalo has posted on Twitter asking who the first politician would be to accept their paycheck in Bitcoin. Mayor Suarez took advantage of this opportunity to show his support for cryptocurrencies by saying he was accepting his next paycheck in Bitcoin. This is unprecedented, as no US politician has openly admitted they would take payments in Bitcoin. Mayor Adams responded to this with an even more impressive revelation. The mayor, who had been voted into office on November the 3rd, revealed that he planned to take his first 3 paychecks in Bitcoin. This move was made in a bid to one-up the crypto-positive mayor of Miami and show New York's commitment to making it the crypto hub of the nation. In New York, you always go big, so I'm going to take my first 3 paychecks in Bitcoin when I become mayor. NYC is going to be the center of the cryptocurrency industry and other fast-growing innovative industries. Just wait. Mayor Eric Adams is only the second black person to be elected to the mayoral office of New York, and his campaign revolved around making New York City an innovation hub, which resonated greatly with the younger residents of the city. His stance on crypto also drew the community to him. Now that he's won the race for mayor, Adams is focused on making the 60 a tech hub. Taking paychecks in Bitcoin is unheard of, but not a new concept in any way. Some payroll companies have also begun to offer options to pay employees in crypto. But Mayor Adams and Suarez will not be receiving their paychecks directly in crypto, as they're paid by the government. They will receive their paychecks in dollars, which will then be converted into Bitcoin. Suarez has in the past explored the idea of paying salaries in Bitcoin, and Mayor-elect of New York, Eric Adams, has so far not said anything to that effect. But the future of Bitcoin looks bright in New York with Adams running the show. And a draft bill seeking to allow Brazilian workers to be paid in Bitcoin was presented to the country's deputies' chamber on November the 5th. The author shared the natural evolution of money as a case for his proposal. Money was one of the greatest creations in the history of humanity. said the draft bill. It allowed us to rise from a primitive barter-based society to an extremely complex and productive society. Bitcoin is a natural evolution of money, whereas all previous forms compromised on a few properties, divisibility, durability, scarcity, salability across time and space, etc. Bitcoin enabled a new paradigm in the history of money. At the peak of the financial crisis of 2008, Satoshi Nakamoto, in their white paper, proposes a digital monetary system without the need of trust in a financial institution. The draft bill reads, "Our proposition meets this modernity, establishing that a worker may optionally receive part of their income in any type of cryptocurrency existent in the financial market." Brazil has been making the headlines lately when it comes to Bitcoin. A recent bill that sought to legalize Bitcoin and cryptocurrency in the country, as well as enforce stricter rules for businesses seeking to provide related services, was misunderstood as a step in the direction of making Bitcoin a legal tender in Brazil. Overall, Brazilians are big into Bitcoin. The broader cryptocurrency market has seen more activity than the stock market in the country for a few years now. But the bill is just a draft and was only presented to the Chamber today. Deputies still need to discuss it and take it to the vote for the draft bill to be considered. And there is also the possibility that this law may never get enacted. In either case, though, since it was recently presented, more information will emerge in the coming weeks. And Bitcoin was down 1.13% to 60,988 at the time of writing, and Ether was down 0.61% to 4,480. With signs of crypto intruding more into the mainstream, my next live show on Tuesday with Adam Stokes is certainly timely. So mark your diary and join us at 8 p.m. Sydney time. And back to that broader conversation where I said that the markets are definitely pricing in optimism, but those inflationary forces are providing huge pressure on many households and businesses. And if in fact interest rates do start to rise sooner rather than later, that'll just turn the screws some more. The only way out is to try and push for higher wages. Now, some will be able to do that in some sectors, but I think the squeeze is going to get very severe. And bearing in mind the high levels of financial stress we already detect in our surveys, many households and businesses in Australia will find the next few months quite difficult to cope with, despite the buoyant markets. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.